American Tower's stock price has been declining significantly over the past year. Now, I wanted to go over why I decided to make an investment into this company. So, over the past month, American Tower stock is down about 10%. Over the past 6 months, it's down about 22%. And year to date, it is down a whopping 25%. So, let's go and look at American Tower's business. So, the company, American Tower, actually operates in the communication sector. So they design, develop, and lease out these cell towers to specific cellular companies to operate their communications network. So essentially, this tower could be leased out to T-Mobile or Verizon Wireless or Sprint. So that is what American Tower essentially does. So American Tower is a leading independent owner, operator, and developer of multi-tenant communications real estate. Now, 98% of their revenue is generated from leasing their properties, as they show here, and from leasing specific data center facilities. So this is a very nice infographic here, and it has a couple of sections that I want to break down. So first of all, again, this is for wireless communication networks. And again, the examples I used could be cell phone companies such as T-Mobile or Verizon Wireless. Now, wherever you see an AMT labeled, that is operated by American Tower, and TEN stands for operated by the tenant. So the tower structure, which is made of galvanized steel, has capacity for multiple tenants. And again, we'll look at that in a minute, what that means. And the land here, again, was developed and owned and operated by American Tower, which they lease on long-term leases to specific tenants, being these wireless communication network companies. So the antenna here, the antenna equipment, and again, these facilities such as the HVAC or the coaxial cable are operated by the specific tenants. So how large is American Tower? American Tower is huge. Now, they operate on a global scale, and they have roughly 226,000 communication sites. So this map is great. You can see that they are global, like I said, very concentrated in the United States, but they also have other great areas in which they can continue to grow. They have a high concentration here in India, almost 78,000 sites here in India. They have room to expand here in South Africa and over Europe as well. So great global scale here by American Tower. So this, again, I refer to multi-tenant leasing as they did as well. But basically, this business model that American Tower operates is very scalable. And in my opinion, is a great business model in terms of future gross margin growth and future revenue as well as EBITDA growth. So when you look at this tower that they've made, once these initial costs are incurred, this land is developed, this tower is made, those are basically the most significant cost in their business. And then they lease it out to one tenant, this representing one tenant. Again, this could be one cellular company. Now, the beauty of their business model is they can add additional tenants at barely any cost, because the majority of those costs have already been incurred when they were building the original site. Now, adding these additional tenants, equipment, and upgrades yields additional revenue while their costs remain relatively flat. So again, a very scalable business here in my opinion. Now let's go and look at some numbers behind that. So they have a sample tower economics here explaining the economics or the costs and profit here associated with if they had one tenant, two tenants, or three tenants. So the initial startup costs or construction costs, roughly $275,000. If you have one tenant on here, it generates about $20,000 of revenue. But as you keep adding additional tenants, that revenue keeps expanding at a great rate. So you go from $20,000 to $50,000 to $80,000 of revenue. And again, look at the operating expenses here. They do not go up. And if they do, it's very slightly, a couple of $1,000s for that additional revenue. As you can see, the gross margin in terms of a numerical dollar value and a percentage value increases very significantly as well, going from 40% of a gross margin all the way up to an 83% gross margin. Now, the return on investment or ROI from one tenant jumps from 3% all the way up to 24% with the addition of those additional tenants. The Tower model demonstrates significant operating leverage as tenancy increases. So let's look at these key financial metrics and how they have grown over the past 10 years. So revenue, again, has grown over the past 10 years at a 14.1% compound annual growth rate. Now, revenue is not the end all and be all. We want to see that translate into profitability. Now, the EBITDA, or earnings before interest, tax, depreciation, and amortization, has grown in line with the revenue at 13.4% compound annual growth rate. Now, this is a REIT, so again, we want to look at the all-important AFFO, or the adjusted funds from operation, and as that is attributable to the common shareholders per share. This has grown at a very nice rate of 12.4% compound annual growth rate. So again, a very, very high growth rate here for the AFFO, and the return on invested capital over the past 10 years has hovered around that 9 to 10% ROIC. So again, great numbers here. Now, all of this has been complemented by an average annual dividend per share growth rate of 20% per year since 2012. So growing that dividend at 20% per year, that is music to my ears as a dividend growth investor. So let's jump over to Seeking Alpha. So I'm using Seeking Alpha here for all of my financial analysis. I really like Seeking Alpha in terms of their user compatibility and user friendliness. And I really think it's a great software here in terms of analyzing stocks and looking at a past history of their financials. So if you would like to go and download Seeking Alpha or create an account, I'll leave a link in the description below for you to go and do that. And full disclosure, I do get a referral fee if you do click that link and sign up through Seeking Alpha on my channel. So let's go and look at some of these metrics. So we can see that right now American Tower is trading at $160. That's close to its 52-week range low of $154. And the high here was at $235. So it has dropped very significantly from that high. And again, most REITs, if you've been following my channel, they have dropped as a response to the raise in interest rates. Now let's go and look at their dividend. So $6.48 is a dividend. It's a nice 4% yield. And let's go and look at that dividend in detail. So here we can see, again, these grades. We're going to go and dive into each of these grades and see how valid they are, or what I believe to be their actual grade. But dividend safety is C-, the dividend growth at A-, dividend yield a D, and dividend consistency an A. So the summary here of the dividends: 4% yield, that's $6.48 annual payout, a low payout ratio here of 65%, 5-year dividend growth rate of 15.96%, and they've been growing that dividend for 10 years at a super high rate. So great to see here in my opinion. Let's go and look at that dividend growth in detail. Over different timelines, we can see that the dividend growth over the past 3 years is 13.37%, over the past 5 years is 15.96%, and over the past 10 years, as they stated, is close to that 20% mark. So over the past 10 years, it has grown at a higher rate, and it has come down a little bit over time. Now, we as dividend investors, we love to see these high annual dividend growth rates, but one thing we want to make sure of is that this dividend is sustainable. The company can pay out that dividend without putting financial stress on their operations, and we want to make sure that they have enough cash flow to reinvest into the company, ensure that the company can continue to grow over time, and along with that growth, keep growing our dividends. So here we can see the cash dividend payout ratio at 63, almost 64%, but it is a REIT. So let's go and look at the funds from operation, or the adjusted funds from operation payout ratio, and this here being at 65%. As you can see, that's a B+ rating. And again, this is a very low payout ratio in my opinion for a REIT. 65%, leaving 35% of cash to reinvest back into the business for future growth is great capital management here in my opinion from the management of American Tower. So that was the dividends. Now I want to go and look at some specific financials, and again, specifically to draw your attention to why I believe that they could also be trading at such a large discount. So REITs, they have to carry a lot of debt. Now, I don't like to invest usually in high indebted companies just because of the the strain that it can have on a company in terms of servicing that debt. And usually when I invest in companies, I like to look at what I call the EBITDA or the debt to EBITDA ratio. So usually if that ratio is 3, I think that it's fine to invest into that company. They should be able to manage that debt with their annual cash flows and pay off that debt if they needed to. Now, American Tower does have a lot of debt. So if we look at the long-term debt here, we can see that it has increased over time. So it has increased pretty significantly over time. There was a little drop. They did pay it down, and management has said that they will be making an active almost purpose or active cause of paying that debt down. They are intending to pay it down more significantly over the next few years. But I want to go and calculate this ratio because it is still very important. So we can see here about 35 billion. So let's go and look at the calculator. That's their debt. And then we're going to go and look at their EBITDA, or their earnings before interest, tax, depreciation, and amortization. So as we can see, their EBITDA has been climbing steadily. It's about 6.7 billion. So as we can see, that is a very high rate of that debt to EBITDA, 5 times. So 5.25 times, again, that is pretty significant. And with that much debt, the higher interest rates could be pushing the stock price down as valuations come down and people are more concerned about American Tower servicing that debt. So that's just something to keep in mind in terms of their debt level. Now let's go and value this stock. So I'm using my friend Dividendolgy's valuation, REIT valuation model. He has a great channel. Again, I think you should check it out. I'll leave a link to that channel in the description below. Now, I've taken their competitors here in terms of American Tower's competitors being Crown Castle and SBA Communications. I've input each of their stock prices along with their price to AFFO multiple. So here what we are doing is comparing these other companies in terms of a AFFO multiple or price to that ratio to determine whether we think that American Tower is undervalued, at fair value, or overvalued. So as we can see here, this spits out an average AFFO of around 13, and American Tower trades at a higher AFFO of 16.26, suggesting that American Tower or AMT might actually be overvalued. The intrinsic value here coming out at $128.35. So that is in comparison to its competitors. Now let's go and look at a different valuation model, the dividend discount model. So what this model does is it discounts the price of a stock to compute what it would be given the future performance or the future dividend payouts, and then discounts them back on a rate that you would like to input. So again here, when I'm looking at the dividend discount model, I've put the dividend payout ratios or the dividend payouts here, and then the dividend growth rate, and it calculates a average growth rate of 16.83% over the past 4 years. So a very, very high dividend growth. And I am forecasting a much smaller dividend growth rate going into the future, just because I am a little bit more conservative. I don't think they're going to keep growing their dividend at 16% per year. I think 7% is a much more reasonable expectation. Now, what I've done is discount this model, or provided a weighted average cost of capital of 9%. This gives me a DDM price, or dividend discount model price per share, of $313.51, compared to the current trading price of $160.11, results in about a 95% difference. So again, this could suggest that it is highly undervalued. But what we want to do is go and look at the output tab and average these two valuations. Now, one thing I want to make clear here is you're going to see a huge difference here in terms of the valuation models. So the multiples giving a much lower valuation and the dividend discount giving a much higher valuation. Now, the multiples model is based on its peers and their AFFO multiples. So when sectors decline as a whole in response to interest rates or other factors, that will bring this model or this valuation down significantly along with its peers. It's reacting to its peers. Now, the dividend discount model bases it off its future dividend and dividend growth. So again, that provides a little bit of a different valuation. So what this is the average of both. And again, please remember, this is a pretty large difference here in terms of the range. So when you average these two out, it gives you an intrinsic value of $220.93, and the current price is $160.09. So if you wanted a margin of safety of 10%, your acceptable buy price would be $198. If you wanted a margin of safety of 15%, you'd be looking at almost $188. If you wanted a larger margin of safety at 20%, you could be looking at $176. Now, if you're super conservative, you could probably go all the way up to 25%, and it would still be a buy at $165.70. So again, just take that valuation with a grain of salt. As I explained, this is a very, very wide range. And again, valuations, just in their nature, because we have to evaluate on future data, they are not always the most reliable way to value a stock, because we cannot be sure of future data and future results. So that was the valuation model. Now let's go and look at the pros and cons of this. So I have my investment tracking spreadsheet here, and as you can see, I actually did add American Tower. It's a smaller position. I just started a position here at 1.4%, and I believe that it is going to be a strong company in my YouTube dividend growth portfolio. Now, the pros here being it has high dividend growth, it has a low AFFO payout ratio. Now, the cons, and again, another pro, is going to be the transition of the 5G network. 5G continues to roll out. We continue to consume more data. More data is going to be managed and is going to be communicated across various networks. So I believe that their business model will continue to expand both on a local and global scale. Now, the cons here being the high levels of debt. So American Tower it is a REIT, so you should expect a decent amount of debt, but at that 5.25 ratio here of EBITDA to debt, that is a large amount of debt. I would want management to try to pay this off, and I actually would prefer if they even slowed down the dividend growth and they paid off a lot more of that debt. So that would just be my preference. So what am I going to be doing? I'm going to continue to dollar cost average into American Tower, hopefully build it up to a 2 to 2.5% position in my YouTube dividend growth portfolio. But let me know what you're doing in the comments below. Are you just sitting on the sidelines? Are you going to add American Tower as well? Or are you thinking about selling a position that you currently own in American Tower? So that was the video. I hope you appreciated it. And again, if you have any comments, please leave them in the comment section below. If you like that content, please give me a thumbs up and follow for future videos. Thanks, appreciate it, and I hope you have a good day. Bye. Please note, I am not a financial advisor by any means. This content was made merely for your entertainment purposes only. Please do your own due diligence when investing. Investing is inherently risky, and I am not liable for any investing losses or decisions you may incur or make. Thank you for watching. Have a great day. Bye.